Hi everyone, welcome back to the channel. So in this video, I'm going to be showing you why I personally don't think Apple stock is a good investment at these prices. In fact, I actually think it could turn out to be a pretty bad investment. And that might surprise a lot of people considering how Apple is one of the best quality companies in the world and obviously is going to be around for a while. So in this video, I'll walk you through why I do think Apple is substantially overvalued at today's prices and what kind of downside I think is possible in the stock. Okay, so some quick notes first on Apple. Right now we're on FinViz. So a couple things to note. First, the price to earnings ratio is a 37, forward PE is 28. So these are numbers that we'll come back to, and their earnings per share growth for the next 5 years is estimated to be around 12%. So these are numbers to keep in mind as we go through this video. So first is the issue with Apple's growth, because I think the story has changed with Apple in a way that not a lot of people are realizing. Because at the beginning of the past decade, Apple was a hyper growth stock, growing at high double-digit returns, both revenues and earnings, and we're really focused on expanding new product lines and innovation. Now I think this has sort of changed where we've seen Apple's growth substantially slow over the past few years. And again, now with the fact that they recently broke a $2 trillion market cap, making them the largest company in the world. $2 trillion companies can't be growing at 20% a year anymore. It just doesn't make any sense. And so because of that, I think this slower growth is here to stay, which gives a different picture compared to the valuation of the stock price currently. So on this website, quickfs.net, it shows you the 10-year history of companies. And so this is where I like to go to find long-term information on a company's financials. And first we'll look at revenue growth. Going back all the way to 2011, obviously revenue growth was very strong, 66%, 44%, then dropped down to 9%, sort of up and down. But the thing to notice is that generally from 2011 to 2015, revenue growth was very high. However, since then, it started to slow down a little bit, where we had negative 7% 2016, 6%, 15%, negative 2%, and this year 5.5%. So I think this is significant where Apple from 2011 to 2015 could be considered this classic high growth stock with revenue growth in the 20% or more. Over the past 5 years, it's been more of a steady, slow grower, growing at 5 to 10% a year, sort of in line with most other large companies that make up an index like the S&P 500 or the Dow. Another thing we can look at is earnings per share growth, and this is really the same story. Huge growth from 2011 to 2015. You have 80%, 60%, 13%, 40%. And then again, over the past 5 years, it slowed down a little bit where we have a couple of years of negative growth, then 2017, 10%, 2018 was a good year with almost 30%, and then 10% again this year. So again, sort of the same story. Apple's not growing as fast as it was in the past, and that is going to become a problem, especially when we look at how the valuation of Apple has changed compared to what multiple they were trading at back in these years of 2011 to 2015. Now, for the last note, obviously these growth rates aren't everything. It's also important to look at numbers like return on assets, return on equity, and return on invested capital, ROIC. And these numbers are all excellent for a company like Apple. They've stayed consistently in the double digits, and this year 17% return on assets, 73% ROE, and almost 40% ROIC, which are very good numbers. So this video isn't me trying to argue that Apple is some horrible company that you should never own. In fact, the opposite. Apple is one of the highest quality companies in the world, and I think that is a reason why the price has run up so much recently. Okay, now we're going to take a look at some valuation metrics for Apple. So the first one is obviously the basic PE ratio, price to earnings, measure the price of the company versus the earnings that they bring in. And you see something very interesting when you look at the history of this number. So the bottom line here is the PE ratio. And so obviously PE ratio isn't everything. One thing that a stock's earnings multiple depends on is its expected growth rate. So for a stock that is expected to grow at a faster rate, you'd expect the stock to trade at a higher multiple of earnings compared to a company that's not growing as fast. And so what's interesting is with Apple, it's actually sort of the opposite. Again, like I showed you on the last website, Apple's fastest growing years were 2011 to 2015. And if you take a look at that time period in terms of PE ratio, most of the time they were trading between 10 and 20 times earnings. In 2010, they were at 16 times earnings. Then they fell down to under 10 times earnings. They hit a low of 8 times earnings in 2013. And again, really until 2016, this price to earnings ratio has really stayed mostly between 10 and 15 times earnings. But we see a different story in the past 5 years, even though, like I showed you, Apple's growth has been slowing down, the valuation given to Apple by investors has actually increased. So even going towards 2017, 2018, still on the higher range, 15 times earnings, but definitely still in the normal range. But really this year is where things really took off for Apple in terms of stock price, and they now shot all the way up and they're trading at 37 times earnings, which is about twice as expensive as is usually valued by the market. And again, this by itself doesn't mean much, but when you take into account the fact that now Apple's valued more expensive than at any point in the last 10 years, and the fact that their growth has slowed down, not sped up, taking those two factors together doesn't make things look good for Apple. And in terms of context, the last time Apple's stock was valued at over 30 times earnings was in 2007, right before obviously the recession, the real estate crash. And so, over the next couple of years, it didn't take long. Apple fell from 37 times earnings all the way down to under 10 times earnings. And so I know right now there's a lot of greed in the markets and a lot of investors thinking a company like Apple can never go down that much, but it's definitely possible, especially taking a look at history. Now, I think another potential issue about Apple is actually something that a lot of people see as a good thing, and that is the amount of cash that Apple has on the balance sheet. So if we take a look at the amount of cash on hand for Apple through the years, you can see that in the past few years, the amount of cash that Apple is holding on the balance sheet has skyrocketed. Where back 2011 to 2014, this was sitting at around 30 to 40 billion, and now it's spiked up to over 90 billion, and last year it was over 100 billion. And so obviously a lot of investors would see this as a good thing. Obviously, the more cash a company has on the balance sheet, the better financial position they're in, and they can pay that money out as dividends or do things like buy back stock. And obviously I wouldn't argue with that, but the question is, Apple hasn't done anything with this cash in the last few years, and I really don't know what they are planning on using this cash on in the future. Back in the period from 2010 to 2015, Apple was spending billions on research and development, being able to develop and innovate new products, and now it sort of seems like Apple as a company has matured, where they have their core line of products and they're just focusing on improving those every year instead of developing something new. And so now the problem becomes, what are they going to do with all this cash? Because while having a lot of cash is a good thing for a company, it can become troublesome if they run out of things to use that cash on. Because investors are expecting Apple to use this cash to invest in the company, to grow revenues, to grow profits. And so every year that this cash is staying on the balance sheet, that's not happening, and all this money is losing value due to inflation. So obviously this isn't the end of the world for Apple if they're holding a lot of cash, but it probably would make me feel better as a potential investor if they started putting this cash to use as opposed to letting it just sit on the balance sheet for years. Okay, and now finally we're going to take a look at the valuation of Apple. Okay, now finally we're going to take a look at the valuation of Apple stock. So I'm going to do this through Guru Focus, their discounted cash flow calculator. Whenever I'm analyzing a stock, this is something I use to get a picture of what the fair value for the company is. And there's two ways that this calculator works. So the first way is a normal discounted cash flow calculator where you have inputs that you have to put in. So to walk you through these inputs, the first thing is the discount rate. I put this at 8% a year. I'm assuming if you invest in Apple, you want to earn at least the normal market rate of return, which is considered to be around 8%. And so this is a conservative number. For me personally, if I invest in a stock, I want to earn a rate of return above the market average, which is why I pick individual stocks. So this 8% is a conservative number. And for me to invest, I would want this to be considerably higher. The second part is the growth stage. So this is a two-stage discounted cash flow. First, for the first 10 years, it is assuming a higher growth rate, and for the second 10 years, it is assuming a lower growth rate. So for the first 10 years, I put a growth rate of 12% in line with what analysts are expecting for the next 5 years. And then for the terminal stage, for years 10 to 20, the growth rate will be at 4%, assuming that Apple matures over the next 10 years and then is growing at around the rate of GDP. And so when you plug these into the calculator, you'll see that the fair value of Apple is around $82. And if you take a look at the stock price right now, Apple is trading at $123. So what this is showing you is, based on these assumptions, if you do think that Apple will grow earnings at 12% a year, and you want to earn at least 8% a year investing in Apple, you would have to wait until they drop down to $82 to be able to achieve this. Right now at $123, this valuation is around 50% more than the estimated fair value. And so right now you actually have a negative margin of safety with Apple. And so that's really the main reason I wouldn't invest in Apple stock. I only invest in stocks when they're trading ideally at 50 cents on the dollar or less. And so for a company trading at 50% more than what the fair value is, even though they're an incredibly high quality company, it's not something I'm willing to invest in. Now, the second way to value this is with the discounted cash flow model. And so this takes the normal discounted cash flow formula and turns it on its head. Instead of you putting in inputs and the calculator spitting out a fair value, the calculator takes the current value of the stock price and then gives you the rate of growth that the company has to achieve to be able to justify those returns. And so this calculator is basically saying, right now, Apple at $123, the stock has priced in around 18% growth per year over the next 10 years. And so there's a couple things with that. First thing is Apple is now a $2 trillion company, and I think it would be extremely hard for them to grow at 18% a year. Secondly, if you take a look at their average growth rate, even accounting for the past 10 years where Apple had much faster growth in the beginning of those 10 years, their average growth rate is still only 16% a year. So to think Apple is a good investment right now, you have to assume that they're going to grow faster over the next 10 years than they have over the past 10 years. Now, that being said, could it be possible that Apple does grow at 18%? Maybe, perhaps it is possible. Obviously, there's a lot of news about Apple investing into 5G and their new 5G enabled iPhone and the new so-called super cycle of a large amount of people needing to upgrade their phones. Maybe that's what the market is pricing in terms of this 18% growth rate. But even with all of that, I think it would be extremely difficult for a company as large as Apple to be able to sustain that growth rate for the next 10 years. And so it's really for this reason right here that I'm not invested in Apple. Now, obviously, this would be a different story if you invested in Apple in the past. As if you invested in a valuation that it was trading at in March during the stock market crash, that might have been a good place to pick up some shares of Apple. But definitely right now, at near its all-time high, I would not consider Apple a good investment in terms of the expected returns you would get over the next 10 years. Now, the last thing to talk about with Apple was how their last quarter's earnings were actually a little bit of a disappointment, where even though overall it was a good earnings call, the company beat estimates for revenue and profit. We saw things like iPhone sales continuing to lag. So this has been a problem with Apple for the last couple of years. Their iPhone sales have been lagging. And the biggest problem with this earnings call is the company didn't give any guidance. The company stopped short of providing forward guidance for the third consecutive quarter. And so I think this is a big problem for Apple stock. For a stock that's priced in growth of 18%, you want to have management have confidence that they're going to be able to grow that fast. And so it's not a great look when you don't give guidance. Usually that means management is unsure of what next quarter's results are going to be in terms of growth. And even though the CFO says iPhone sales are off to a great start, that doesn't really mean much when you're not able to come up with a concrete estimate of what iPhone sales will actually be. And so this earnings result was around a month ago. And after this, Apple stock tanked. They saw 111 billion in market value erased on the one day. So I do think with these issues facing Apple, it definitely doesn't deserve to be trading at its current valuation of over 37 times earnings. Now, in terms of where Apple stock potentially would be a good buy, for me personally, $80 would be the absolute max, especially considering with that discounted cash flow valuation, you put in a 12% growth rate, which even that I think is a little high for a company as big as Apple. So for me personally, I wouldn't invest in Apple unless the share price got to at least $60 or ideally less. Obviously, that would mean a 50% haircut in the price of Apple stock. So I'm not expecting that to happen anytime soon, even though I do think eventually Apple will trade more in line with its normal valuation. So that's it for this video, me outlining my thoughts on Apple stock's current valuation and what kind of expectations are priced into the stock based on the current valuation. Let me know down in the comments if you own Apple stock or if you've been buying Apple stock over the past few months and what your rationale is for doing so. Obviously, I could be wrong, so we will see what happens. If you found value out of this video, hit the like button to help out the channel. If this is your first time here, subscribe to the channel. And that's it for now, so I'll see you on the next video.